credit allocation. I was wondering, why do that when a lot of people say the 30-year big bull run for bonds is just about over and we're in for a period of rising rates?
I think we're in a period for rising rates, but that period of rising rates is not going to be the same across the yield curve. So our view about expanding credit is that at the long end of the credit curve, you're going to see very strong institutional support from corporate pensions who want to buy long duration corporate credit. And then inside the 5-year, for example, the yield curve is still very, very steep. So there's a lot of, it's very attractive from a total return standpoint to basically roll down the yield curve. In addition, there's very strong institutional support for investment grade credit from really non-US investors inside of 5 years.
So you're saying, but in terms of expanding credit allocation overall, what's the thinking behind that?
Our view is that one of the benefits of the quantitative easing that's gone on, especially in the credit markets, is that you've pushed out the credit cycle even further, because a lot of the QE money that's come in has actually led to refinancing. So the default risk that may have started to increase here without it has been pushed further out. And so from a default standpoint, defaults are going to be lower. Balance sheets are still very, very strong. Would really suggest that credit is really designed to outperform, for example, let's say mortgages in this environment.
And Mark, you mentioned default risk. In terms of high yield, you're saying go for the triple Cs. I mean, that's the lowest of the low. Why take that big risk now?
Again, it's the balance sheets for a lot of even the triple C companies are very, very strong. They've managed to refinance risk. And you don't see a whole lot of triple C companies that need to refinance that debt. The other reason for triple Cs is that they, as you said, are kind of down the credit spectrum. They are really the purest play really on credit and very less interest rate sensitive. So you've got an asset class, if you will, triple Cs that have very low interest rate sensitivity, very high yield, and you expect default rates to be low going forward. It becomes very attractive for you to be certainly in the triple C space.